Okay, so if you manage or maybe audit a charitable trust, the new Income Tax Act of 2025 is basically about to flip your tax calculations and compliance filings upside down. Welcome to today's Explainer.
Now, the big question on everyone's mind is how exactly do we transition from the old 1961 regime to these brand new rules? Today, we're decoding the special provisions for registered nonprofit organizations under Chapter Xvii, specifically Sections 332 to 355. If you're a CA, a tax professional, a student, or a business owner managing a trust, getting a grip on this transition is absolutely critical.
To answer that, we've got a really structured syllabus for you today. We'll start with an introduction to the NPO provisions, then decode the NPO income rules, walk through a practical taxation example, cover compliance and filing, discuss transition and common issues, and finish up with a summary of key takeaways.
All right, let's jump right into Section 1, Introduction to NPO Provisions, Navigating the New Framework for Charities.
You know, the 2025 Act actually does us a huge favor by significantly reducing legislative complexity. Think about how we used to operate. Instead of jumping between all those scattered chapters, weird exemptions, and confusing clauses from the 1961 Act, the trust provisions have been beautifully consolidated. They now sit in this really streamlined, single framework right under Sections 332 to 355. It just makes navigating the law so much more intuitive.
Let's put the old and the new side by side for a second. Under the 1961 regime, we were dealing with a heavily fragmented landscape, right? We had Sections 12A, 12AB, 1023C, all governing completely different entities with their own sets of rules. Now, it's all unified under Chapter 17B. And crucially, you got to update your vocabulary. What we used to call the previous year is now strictly the tax year. Plus, all those fragmented terms, trusts, institutions, hospitals, they're all consolidated under one single umbrella term, Registered Nonprofit Organization, or NPO.
And that brings us to Section 355G, which is literally the bedrock of Chapter 17B. It defines a registered nonprofit organization as any person having a valid registration under any specified provision, where that registration hasn't been canceled. Why does this matter? Well, it ensures that uniform rules apply seamlessly across the board. So whether your client is a public trust, a registered society, or a Section 8 company, in the eyes of the new law, you are now simply a registered NPO.
Moving right along to Section 2, Decoding NPO Income Rules, Understanding Regular, Taxable, and Specified Income.
So the core principle here is going to sound very familiar, but it is now firmly codified. To maintain a nil tax liability on regular income, an NPO must apply, or formally accumulate, at least 85% of it for charitable or religious purposes. This mandatory application requirement is super strict, and it leaves you with your standard 15% allowance for free accumulation. This right here is the absolute cornerstone of NPO taxation under the new Act.
What's really interesting is how strictly the 2025 Act slices up these income categories. First up, we have regular income under Section 335, which includes your voluntary contributions, property income, and permissible commercial gains. Second, if you fail that 85% test we just talked about, the shortfall instantly becomes taxable regular income under Section 336. Third, and pay close attention here, is specified income under Section 337. If you provide unreasonable benefits to founders or related persons, that specific income gets hit with a strict, flat tax rate of 30%. Ouch. Then there's residual income for stuff chargeable under general provisions. And finally, corpus donations remain specifically protected and totally excluded from these mandatory application rules.
Let's make this concrete. Section 3, a practical taxation example. Calculating taxable regular income. Okay, let's run the numbers on a hypothetical NPO. Imagine they receive a total regular income of 1 crore rupee. Under the law, that minimum required application is 85%, meaning 85 lakhs absolutely must be applied to their charitable objects. But let's say during the tax year, they only actually apply 80 lakhs. They still get their permissible free accumulation of 15 lakhs, sure, but as you can see, that leaves us with a clear shortfall in application of 5 lakh rupee.
So, what happens to that 5 lakhs? Well, it's definitely not automatically exempt. You calculate your 85%, deduct the actual application, and look at the remainder. Unless that money is formally set apart for future use by filing an accumulation statement, which is Form 10-9, that entire 5 lakh rupee shortfall legally transforms into taxable regular income under Section 33C. And yes, your client will be paying tax on it.
Which brings us perfectly to Section 4, NPO Compliance and Filing, Navigating the Income Tax Rules 2026.
You'll definitely want to bookmark these new redesigned forms under the 2026 rules. Form 104 and 105 are now your absolute go-tos for securing provisional and regular 5-year registrations under Section 332. Form 109 is what you need to officially accumulate that regular income we literally just calculated under Section 342. Form 112 is your newly structured mandatory audit report under Section 348. And finally, Form 113 handles the statement of donations received under Section 354. Now, this is actually a huge relief for a lot of folks. The new rules introduced a tiered system for audits under Form 112. The law clearly defines small NPOs as those with a regular income up to 5 crores, foreign contributions up to 10 lakhs, and application outside India up to 10 lakhs. If your NPO checks all those specific boxes, you get to enjoy a significantly lighter compliance and reporting burden during your audit compared to large NPOs, which are just entities that exceed any of those 3 thresholds.
All right, Section 5, Transition and Common Issues, Avoiding Pitfalls in the New Regime.
Here are the practical pitfalls you absolutely must avoid. First, for NPOs engaged in general public utility, or GPU, your commercial activity receipts legally cannot exceed 20% of your total receipts under Section 346. Second, providing unreasonable benefits to related persons, that doesn't just lose you your exemption anymore, it triggers severe penalties under Section 445 equal to the benefit provided. Third, if you fail to maintain strictly separate books of accounts for any commercial activities, it'll completely invalidate your claims. And lastly, just remember that your existing 1961 Act recognitions remain perfectly valid, provided they aren't inconsistent with the new 2025 Act.
And speaking of existing recognitions, if you or your clients are stressing about transitioning from the old Act, take a deep breath. The official CBDT FAQs provide some massive relief here. FAQ 4.35 explicitly confirms that a provisional approval granted to a charitable organization under the old Act shall not be invalid merely because the new Act commences on April 1, 2026. Your existing provisional and regular approvals seamlessly carry over. Finally, Section 6, Summary and Key Takeaways, Mastering Chapter Xvii 7b.
Let's wrap this all up into a quick action plan. First, make sure you update your internal terminology to tax year and registered NPO under Sections 332 to 355. Second, you really need to enforce strict discipline regarding that 85% application rule to prevent unwanted tax liabilities for your clients. Third, adapt your practice to the new Income Tax Rules 2026 forms right away, especially Form 11 for audits and Form 109 for accumulation. Fourth, diligently safeguard that GPU status by capping commercial receipts at 20%. And finally, transition confidently. Your existing 1961 Act approvals are still valid where consistent.
Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.